So is whole life insurance really a good investment? Well, if you're looking for like putting your toes in the sand and beautiful sunshine on beaches and everything, this alone will not do it. Plus two, whole life's not an investment anyways. It's a savings vehicle, not a retirement account, not an investment or anything like that. But I will share with you what you can actually do to use this along with investments so that you can actually have an amazing retirement where you can live your life now, not tomorrow. So as a disclaimer for this video, because you got to make all the regulators happy, right? Whole life insurance or infinite banking or anything else you're talking about with this is not an investment. It is not a good investment from that standpoint. It's not anything you actually go and invest in any kind of vehicles or things like that. It's literally like a savings vehicle that you're getting, right? Not much different than like getting a CD, but it's with an insurance company. That's the key thing. It's really a death benefit, right? It's something that pays at your death, but it also has a tax-free savings account inside of it. That's great, but again, it's not an investment. Now, the real question you might be asking is it even a good investment of my time and money and energy to put into? And the answer is yeah, it can be if it's designed the right way. So first, let me explain how it really works, right? Whole life insurance, like any insurance for that matter, it's mostly death insurance the way it's pitched, right? Now, whole life insurance does have that death benefit, but it also has that benefit of a tax-free savings account inside of it. Now, that savings account inside grows tax-free, can come out tax-free, much like a Roth IRA. The difference is though, is that it's not invested in like stock markets or mutual funds. Yes, there are insurances that do that. This is not that thing. It's very boring. You might make maybe 5 or 6% or so a year because interest rates are higher right now, right? You're making money from that kind of effect. But it's really the most boring thing you could possibly think of. It really is. So just understand that the money that's in there does grow and compound tax-free. The nice thing though, is that depending on where you live, like which state you live in the United States and things like that, it can be 100% protected from lawsuits of creditors. It could also, like I said, it's tax-free, so you're not getting taxed on that money, so it saves you one more tax statement that you don't have to turn into your accountant every year. And it's one place you can actually guarantee it's gonna be there. The cool thing is, it's not just the amount of money growing inside of this thing that works. That's good. That's a good place to store some solid money, but there is a money-making aspect that you can use this for to go along with your investing. So let's dig into that right now. So many times on this channel, you hear me talking about making money in two places at the same time, right? Well, how do you make money in two places at once? Now with this whole life insurance, like I said, it's like a tax-free savings account. You can withdraw the money and then you can take that money and use it for whatever you want. But the thing is, when you withdraw the money, just like when you withdraw from any savings account, what happens? That money is now gone. So that savings account depletes. You stop earning interest inside the savings account, don't you? But now you do have the money to go and invest, but you're just making money in that one place, in that investment. But you've now lost the ability to earn interest in the savings account. Well, wouldn't it be cool if you could still earn money in the savings account and earn money in the investment at the same time and get paid in two places at once? Well, that's what you can actually do with life insurance. Now, could you technically do this with a bank at a savings account? Yes, but the problem is they'll pay you this much while charging you this much, right, in interest when you try to borrow from a bank. Because you could go to a bank and say, hey, I've got 25,000 sitting in savings. By the way, this is what I did. 2006, just to test it out, I went to my banker and said, I got 25,000 just sitting in savings. Can I get a line of credit against it? And the banker said, well, yeah, of course. And yeah, we pay you almost nothing, but we will charge you interest on that line of credit. Now the deal was, if I paid back the line of credit, they would charge me monthly payments. As I paid it back, as I paid that loan balance down, they would free up the cash that was in my savings account. So they would make sure that I wouldn't pull the money out of my savings account. The savings was the collateral, and they gave me the loan based on that collateral. So as I paid the loan balance down, say I've paid it out at $20,000, now $5,000 was freed up in my savings account that I could withdraw or use. The same thing happens with life insurance, but instead of getting paid 0.nothing% while getting charged 4 or 5+% with the bank, instead, I'm earning inside the policy, I'm earning at least 5.5% or so on my money, while at the same time, I might be borrowing it maybe at the same rate or pretty darn close to that same rate. That's the difference, because now I can make money. And the key thing is this, is that my money is growing in there, it's compounding, while the money I borrow is simple interest that goes down over time. Well, how does that work, Chris? Let me illustrate that for you in this example. Say that you have $100,000 sitting inside your life insurance savings account here, that cash value account. If you have $100,000 in there and you want to borrow $50,000, just so you know, you don't pull the money out of your own account. You're borrowing from the insurance company while your $100,000 is still sitting there earning tax-free compounding interest, right? Now you borrow from the insurance company $50,000 and let's say I invest that into a real estate deal. Let's say that real estate deal pays me $5,000 a year. What would I do with that? Well, normally if I just pulled out of a savings account, I would put that $5,000 a year back into my savings account to build it back up so that I can eventually reinvest it again, right? Same strategy, but instead what I'm doing is I'm taking that $5,000 and I'm using that to pay down my line of credit that I owe to the insurance company. Here's the great thing about the loans you get from insurance companies. Unlike the bank that charged me every single month and I had to pay it every single month, the insurance company does not do that. There is no minimum monthly payment. They do charge you interest, but you pay it back however, whenever you want. The deadline for paying it back is my death, right? So, and even then they just take out the death benefit and still pay the rest of the death benefit to my family tax-free. So they don't worry about me paying that money back. They let the loan stay outstanding for years or decades if I want it to. But the way to make it work, because many people will argue with this. They'll say, yeah, but Chris, what if they charge you a higher interest rate than what you're earning over here? Which happens in many, many cases. That's fine, because if I take that $5,000 of cash flow, use it to pay down that line of credit, the interest that they charge me goes down, down, down. While at the same time, the money they're paying me compounds and goes up. I actually showed this to somebody because they were like, wait, I'm a business professional. Like I train people like how to deal with their business finances. This doesn't make sense. I literally pulled out a compounding interest calculator, compared that to a simple interest calculator doing this very example. And when she was shocked, she's like, oh my goodness. Like even in year one, I'm earning more interest because that full 100,000 is paying me interest while the 50,000 loan is charging me less. And then of course, as you're taking the cash flow, paying it down more and more, there's just less and less gets charged. You make thousands and thousands of dollars more in interest. I do another example. If you look at one of my other channels I have a Money Ripples podcast channel. I do like a master class where I teach about this, putting a down payment on an apartment building. I use my own policy as the example. And between that versus getting a savings account, it was like $1,200 a year over 9 years of interest in the bank versus over $120,000 over 9 years using my policy. Why? Because they're paying me the whole time. It's like having a line of credit, but they pay you interest too, which is exactly what happens. So that's how you make money twice. Now you're not gonna get rich off of that alone, right? That's not the thing. But imagine this. Imagine if you were always just using your savings to go and pay for that one thing. You're taking that cash back, great, you make a little bit of money, but if you can also have money coming back that now makes you thousands of more dollars, that just gets you to speed up your investing faster, doesn't it? It gets you to accumulate more cash faster to then go out and reinvest, and that could shave off sometimes years of your retirement goals that you're trying to get to. So is whole life a good investment? It's not an investment, right? It's not, it's a savings vehicle. But what it does allow you to do is it does allow you to be able to make money in two places at the same time. And that's where the real magic happens. All right, now, I'll give you another example here because I had two friends these guys are like amazing investors. They've been doing business and investing for many years. One of them has sold businesses for hundreds of millions of dollars. And they were starting to get to this debate about it because one of them said, hey, my grandfather taught me to do this. He owned a bank. They literally would use this instead of their own bank to be able to use their money because they would make more money this way. And he's like, you make the money and you keep cycling that money through. The other investor said, yeah, but if I always have to take the cash flow and keep paying back towards that loan, when do I actually get to enjoy the cash flow, right? When do I get to live my life now, not tomorrow, you know? And I finally had to stop them both. I said, you're both right. You both can do it that way. But yes, you can actually stop doing this method, right? You don't have to do this forever. So if you're accumulating money to keep investing and building that retirement type of income or that passive income you're trying to create, great. Taking this strategy and keep paying it back is perfect. But what I had to explain to my friend is I said, but the good news is you don't have to do that forever. You could stop. He's like, well, what about the loans? What if I have the loans? I'm like, you don't have to pay those back. Because the thing is, you're still using the cash, you're leveraging it. But if you get to the point where you want to start enjoying that cash flow and you don't have to keep paying towards that policy, you can do what's called a paid up policy. So at any time, most of the way we design our policies after the 7th year, you can make that policy paid up, meaning you pay no more premiums the rest of your life. It also means they pay off the loan balances and the net cash that's in there just keeps growing guaranteed for the rest of your life without you putting a single dime into it. So I said, for this guy, because this guy would keep buying and selling businesses, I'm like, you're never gonna retire. You will use this thing till you die, right? But for you, you might eventually wanna retire. The great thing is you can stop paying into these things and you don't have to pay into it till you're 60, 70, or 100 years old. You could actually stop paying whenever you want to after that 7th year. And that's the magic of whole life. See, if you go about term insurance, try to invest the difference, you always have to pay for the term insurance, always. And even then, it gets so expensive, it's not even worth keeping in your later years, which is why insurance companies do it that way. But this way, you can actually get your money still working for you, compounding, growing, getting more money, working harder and faster, accelerating the growth of your money, and then eventually have a stopping point where you can say, now I can enjoy it. Now I can retire at whatever age I decide, especially depending on my circumstances. That is the magic. That's why I use it for myself, and that's why so many other business owners and investors use it too, because they realize that this just makes their money work harder for them so they don't have to work so hard for it. Now, everybody keeps asking me, they say, Chris, how do I know? How do I know what's right for me? How the numbers work? Good news, we got you covered. You can go to moneyripples.com. You can actually book a consultation with one of our consultants to find out how to design this the way that fits your life and your strategy the best. Go to moneyripples.com right now.